Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we talk about? Well, in between last week and this week, a great setup turned up and I took it, and I want to show you that setup in just 1 second for the methodology in action. As you know, we haven't seen a whole lot of methodology in action for a while, and then the trades that have set up haven't worked out. And the good news is on a lot of those, they didn't even trigger. But that's what a choppy market is all about as a trend follower. And I'm going to flesh a lot of that out, especially once we begin to trend again and some setups finally begin to hit the IPTs and we trail those stops. And that'll make sense over time as we come out of this choppy range. Housekeeping, I do take requests. It makes my job a lot easier. You can send them to DaveLandry.com/contact. Also, if you want the slides from this presentation and all the other presentations combined, along with PDFs of my 3 books on trading, you can go to DaveLandry.com/StockCharts. If you would like to join me every Thursday night, most every Thursday night, except for holiday weekends, usually, go to DaveLandry.com/webinar. My Twitter is down there, T Following Moron, and YouTube is at Dave Landry. I would encourage you to subscribe and like some videos on my channel. That would be really, really nice. All right, let's talk about the mystery charts. This week, it's not a mystery, it's my latest pick. But what I liked about it was it worked its way higher, and then it began to accelerate higher. It's a strategy I call accelerating momentum strategy, which usually sets up with things that I trade, such as pullbacks, obviously. Notice that it pulled back to the 30 EMA. You could see also that the stock was very persistent in its accelerating move upwards. In other words, it tended to go up day after day after day. And persistency is a really powerful thing. Now, if you notice, it did pull back to the moving average. Not that you always want to wait for it to pull back to the 30 EMA, but that is a good way to kind of quantify and qualify setups. And also, you might want to look into doing some scans with the scanner on StockCharts for that. You can see down here, my Landry light indicator was pretty high. We had about 30 bars of upside Landry light, and then it goes back to 0, obviously, when it crosses the moving average. Here's a recommendation I put on based on a 100K account, 370 shares. Entry of 26.90, protective stop 21.50, an initial profit target or IPT of 52.30, 5.4 risk, and it was a pullback / TKO. TKO because it did drop kind of sharply within that pullback, that nice little wide range bar we have right here. Anyway, there's our entry. As you can see, it triggered over the last week. Our protective stop is down here, and our initial profit target is up here. We have bumped that stop up a little bit as this position has moved in our favor, but it hasn't set the world on fire just yet. But you know me, I like to show you things before they trigger and soon thereafter. That way you can track this stuff to see how it all works out. Good, bad, and indifferent. It's been mostly not so good and a little bad lately, but that's just been the choppy nature of the market, and that's something that you have to learn how to live with. All right, let's get back into Mind the Trade with a focus on the wisdom of Jesse Livermore. As I would say quite a bit, I'm pulling mostly from this book here. I'm also using the biography to fill in a few holes and some color commentary and learn a little bit more about Livermore, the man. For instance, in Reminiscence, I think it's a little bit of an alter ego when it comes to Livermore. It's an autobiography written in the pen name, whereas the biography gives you a little bit more insight, and I'm going to pull more and more from the biography over time. But just a quick, for instance, there is Livermore often says in Reminiscence that he never gets depressed about the markets, but it does say in the biography that he did get occasionally upset and depressed about the markets. So it's kind of one of those things, kind of like me up here preaching to you. Do as I say and not as I do. The other book that I might pull a little bit from, and it's been a while since I read this. It's not the most fantastic book in the world, but there is a lot of Livermore-isms in here that are worthwhile, and it's definitely worthwhile reading. All right, let's jump right in. And a lot of chapters 5 and 6 talk about, in Reminiscence, talk about waiting and being able to sit in your positions and how most people aren't able to do that. And he says, the reason is that a man may see straight and clearly and yet become impatient or doubtful when the market takes its time about doing as he figured it must do. That is why the market does not beat them. They beat themselves. Though they have brains, they cannot sit tight. So along those lines, the market operates on its own time frame. Now, we live in this so-called microwave society where we expect instant gratification on everything. I think the last Blockbuster video just closed recently because everybody wants a movie instantly. Nobody wants to go pick up a DVD, and I think Netflix just stopped sending them out. Everybody wants them right away. So there's a lot of performance pressure on us over a short period of time. And then obviously, if you want to dig a little deeper into that, we have wants, needs, and desires where we don't have time a lot of times to just sit in these positions, even if they're working out nicely longer term. Now, as humans, we tend to have a time inconsistency. And if you want to read more about that, you could Google acrasia. And I have an article on my website talking about acrasia, which is at this link here. But a time inconsistency is we don't value time the same. For instance, if I offer you $500 today or $505 tomorrow, which one would you take? Well, most people will take $500 today. What if I offered you $500 and 365 days or $505 in 366 days? Most people would take $505. Now, it's actually the same. It's only 1 day difference and $5 more. But we tend to overemphasize the short term and not think about the longer term. And that's just kind of a normal thing. And I think it might be, an example might be somebody asks you to do something in 3 weeks. You're like, yeah, I'll do that. But then when it gets closer, you're like, ugh, I don't feel like doing that. Disregarding the big swing and trying to jump in and out was fatal to me. Nobody can catch all the fluctuations. In a bull market, your game is to buy and hold until you believe that the bull market is near its end. I am very guilty of trading too much. I've said that 1,000 times. This is especially true now that I'm doing 2 shows a week. I do the weekend charts every week, and I do this show. And believe it or not, it takes a lot of time to prepare for these shows. Now, as far as picking tops and picking bottoms, he said one of the most helpful things that anybody can learn to give up trying to catch is the last eighth or the first. These two are the most expensive eighths in the world. Now remember, all this wisdom comes from a book that was written 100 and something years ago. And by the way, one of my smaller hobbies, I would say, would be to collect these old books on Wall Street. And I'd say most of my Wall Street books, at least the ones I have left here, because I gave most of them away to my clients, but the ones that I have left, most of them are probably 100 years older or more. But anyway, the 2 most expensive eighths in the world. Now, as a trend-following moron, I buy markets that are fairly high, and I'll show you the lowest I'll buy them and the highest I'll short them here in just 1 second. But in general, like you just saw with that well-established stock, it probably had doubled or so, that SYM I just showed you, before I actually got in the stock. So we're looking for sharp uptrends, and then we're waiting for an entry, we're waiting for that uptrend to resume. We're not trying to get in as soon as the stock goes up. We're waiting for it to rally and then correct. And then, of course, all the things we talk about each week, the initial profit target, and we trail the stop higher. So that's what trend following looks like. That's 90% of what I do, depending on market conditions. Maybe a little less if the market is in a transitional pattern. Now, with transitional patterns, that's the earliest I'll get into a market, is after some obvious sell-off on the short side, or on the downside when the market makes major lows, let's say all-time lows if it's an individual stock, and then it begins to rally in something like a bow tie or a first thrust or other patterns that I call transitional patterns because the market is making a transition. Could also be called emerging trends. So at the least, I'm waiting for an emerging trend. I'm waiting for something like bow tie proper order to turn from downtrend proper order to uptrend proper order before I'll even begin to consider a market that's at very low levels for the long side or very high levels for the short side. So go in and watch the presentations that I've done on bow ties. Now, Livermore didn't seem to let losses bother him. Every time I found the reason for a loss or the why and the how of another mistake, I added a brand new don't to my schedule of assets. And then, as we'll see in 1 second, by following somebody else's advice, he ended up losing nearly $1 million, or at least the opportunity cost of $1 million. So that's of concern. That was one of his more expensive lessons, but he was grateful to have the lesson, at least he claims to be. So you want to learn from your mistakes, and I would recommend that you also learn from the mistakes of others. I have two daughters that are polar opposites in many ways, but in one way, one actually learns from the mistakes of others, and then the other one can only learn if she makes the mistake herself. I love them both dearly, but that's one of the interesting things about the two of them. Now, you want to make sure you're not making the same mistake twice, or even worse, become the definition of insanity. Now, by definition of sanity, I mean Einstein's definition of doing the same thing over and over again, expecting a different outcome. And as I said a second ago, be like daughter number two that learns from the mistakes of others. Now, one thing you could do is you could put commitment devices in place. And these are things that help protect you from you. And sometimes it can be just as simple as walking away. Now, there's been times where I'm looking at a screen and all my position trades are going against me and I'm really wanting to get out. But what I'll do, or at least what I used to do when I lived in the country, is I go walk around the block, and the block where I used to live was 2 miles. And then I'd come back all sweaty. And a lot of times, not all the times, but many times, all these positions had turned positive or turned back positive for the day while I was away. Now, had I sat there or stood there, whatever the case may be, I might have been tempted to exit those trades. So it doesn't have to be some sort of magical type of commitment device. It might be as simple as putting a hard stop in when you know you need to get out of a position. Without faith in his own judgment, no man can go very far in this game. That is about all I have learned. To study general conditions, to take a position and stick to it. I can wait without a twinge of impatience. I can see a setback without being shaken, knowing that is only temporary. I have been short 100,000 shares and have seen a big rally coming. I have figured, and figured correctly, that such a rally, as I felt, was inevitable and even wholesome, would make a difference of $1 million in paper profits. And I nevertheless have stood pat and seen half of my paper profit wiped out without once considering the advisability of covering my shorts to put them out on the rally. I knew that if I did, I might lose my position, and with it, the certainty of a big killing. It is the big swing that makes the big money for you. If I learned this so slowly, it was because I learned by my mistakes. And some time always elapses between making a mistake and realizing it, and more time between realizing it and actually determining it. So what he's saying is he'll allow positions to go against him if he had no reason to get out of the market. Now, I do believe in taking partial profits to kind of cushion the blow. Now, he's considered the boy plunger because he was a boy plunger to begin with when he was plunging into the stock market, and then he had boyish looks as he grew a little older. Now, I do believe, again, in taking some money off the table and then trailing those stops higher. But it is very painful, and I've done presentations before where I show the longer-term trend of a chart that we get in, maybe for 400 or 500, and every now and then as much as 600% gains over a year or so. And a lot of times the market has some pretty abysmal drawdowns during that period. But if you look at the chart, it really didn't do anything horribly wrong. It just corrected, which is actually healthy for a market longer term. Now, eventually one of those corrections turns into something bigger. It happens, spelled with a silent SH. You just have to learn how to live with it. Now, this got me thinking, how do you sit tight in these positions? Now, remember, we go in for the swing trade, and we're willing to hang on longer term. The first thing is your best defense is a good offense. So garbage in, garbage out. Make sure you're picking the best of the best stocks going into the trade. I know it's cliche, but pick the best and leave the rest. This morning I was doing a little writing, and I was thinking about future regrets. When you put a position on, start thinking about what would your future regrets be. Now, obviously the position might not work, but if the position didn't work, would you say something like, oh, you know what, this trend really wasn't that great. I just felt like doing something. I was bored. I needed money. I had some money, or some sort of extraneous reason why you put that trade on. So very hard to tap into that sometimes, but you need to kind of remove yourself and do that to make sure you're picking the best to begin with. One thing I said recently is, since the market's been so choppy, as I've kind of been saying ad nauseum, as you probably know by now, I noticed that the people in my Facebook group aren't showing as great of stocks as they used to. Well, that's number one, because there aren't that many great stocks out there anymore. But more importantly, I think they're getting a little anxious to become a little bit more active again, even though the market really hasn't started trending in a solid direction. And one thing I've been noticing, and I'm probably going to write a piece on this one day, it's watch your butts. A lot of the people are saying, oh, I like this stock, and they show the stock chart and everything, and they tell you why they like it, and they'll tell you some reasons why they don't like it. Now, if you take a trade where you have buts, and you do your post-mortem and you lost money, you're going to think to yourself, damn it, I know I should not have taken that trade. Now, one thing you could do to sit tight is define where you would be wrong and stop out at that level, and only at that level. So just let everything unfold, because remember, as soon as you step into a trade, you're stepping into the unknown. Everything is known 2 seconds before you pull the trigger, but then after that, the unknown begins to happen. You can make it a game and use commitment devices again. Just like, okay, I'm going to see how long I can stick with this position. I'm going to use a stop to get me out. I'm going to walk away from my office, maybe go for a bike ride, a walk, or whatever the case may be. As I often say, busy traders make good traders. I know I've told the story 1,000 times and probably tell it 1,000 more. But one of my clients that I'm really friendly with, he's been a client probably for 20-something years, he told me that his trading just got a lot better. I'm like, well, what did you discover? He says, he started laughing. He says, well, my doctor quit on me at the hospital, who did the night rounds, and now I'm literally working day and night, and I don't have time to micromanage my trades. I'm just taking the trades I should, and then I'm letting the chips fall where they may. So I thought that was a pretty cool thing to do. The other thing that we don't have enough time to get into today, but it would be avoid monetizing your trades, meaning that, oh, I've got so much money, I better take that money before it evaporates. You have to be careful not to do that. And if you do find yourself doing that, try to monetize down to your protective stops. Like, okay, well, don't say, oh, I've got $20,000 open this trade. Look at your protective stop and say, okay, well, if I stop out, I'm going to make $15,000 on this trade and be happy with $15,000, because over time, maybe it'll correct down, not hit your stop, and then take off again. Again, that's fodder for a presentation down the road. Now, Livermore did act on a hunch to short Union Pacific, and he explained that at the time, people were buying any old thing, and he explained at that time, people were buying any old thing, and that the professionals were making fun of the novices who were making a lot of money buying any old thing. Now, he was going against the market at this time, but I kind of think that his hunch might have been in part by the tape might have been slowing a little bit, and that's kind of like defending him. But what I could not defend is that he leveraged so much money on this hunch that he could have easily blown up. Now, over time, you're going to get this sixth sense with the markets, and I'll talk a little bit about that in 1 second. But you don't want to act on that in any kind of way that's bigger than what you would normally do. No trade should be able to change your entire life. Now, let's take a look going back in time. The buying of any old thing reminds me of the big run we had in the late 90s in the NASDAQ. You could just buy any old thing, especially if it had a .com in its name, and a lot of companies added .com to their name in order to make money. Now, on the downside, the market lost 73%. So trees don't grow to the sky, and people forget that the NASDAQ actually lost 3/4 of its value. And I remember that last leg higher in the NASDAQ was just absolutely amazing. I remember the day of the top was the day my daughter was born. I remember making only like 8.5 only, right? Haha, 8.5% on that day. And I remember thinking, I'm not happy with 8.5%, and I would kill for an 8.5% day now, believe me. But that's just markets, and I should have known better. But whenever you're kind of find yourself rolling your eyes at such big gains, you better start thinking about lightening up because it could be coming to an end. Anyway, on the downside, toward the end, it seemed like everybody began to throw the baby out with the bathwater. Back when it was running higher, the market made absolutely no sense, and people were buying any old thing, and things just were crazy. I remember back then I was writing for a website named Trading Markets. It was one of the first websites out there. And anyway, long story endless, one stock I recommended went up, I think it was 56 and a quarter points or something ridiculous like that. And it actually had a clean trigger. It wasn't like a huge gap when it went up. Now, what's interesting is if you go way back to the late 90s and you go all the way back to the sell-off, the market made a complete round trip. So it's the sentiment of the market, and that's something that's going to come up in a little while, and that's important. If you're in a bull market, then the market just goes up. If you're in a bear market, then the market goes down. I had sold as much as I needed to satisfy my feeling. This is the UP trade, Union Pacific. He just started shorting it because he had a hunch. So I followed him without waiting for reports on the last 2,000 shares. It was a pretty good jag of stock for me to sell, even with the best of reasons. It seemed more than enough to be short of without any reason whatsoever, particularly when the entire market was so strong and there was nothing in sight to make anyone think of the bear side. But I remembered that on previous occasions when I had told some of these stories to my friends, and some of them tell me that it isn't a hunch, but the subconscious mind, which is a creative mind at work. That is the mind which makes artists do things without their knowing how they came to do them. Perhaps with me, it was a cumulative effect of a lot of little things, individually insignificant but collectively powerful. Possibly my friend's unintelligent bullishness aroused a spirit of contradiction, and I picked up on UP because it had been touted so much. I can't tell you what the cause or motive for hunches may be. All I know is that I went out of the Atlantic City branch office of Harding Brothers, short 3,000 Union Pacific in a rising market, and I wasn't worried a bit. But I felt sure I had done right to sell UP, and I never get impatient when I feel I am right. What's the sense? Now, I forget the exact price of UP back then, but I think it was in the hundreds. So he's talking $300,000 plus in that one trade. Now, the next day, the earthquake hit. Now, the earthquake was at 8.3 and it lasted 42 seconds. It was an awful disaster, but the market opened down only a couple points. The bull forces were at work, and the public is never independently responsible to news. You see that all the time. If there's a solid bull foundation, for instance, whether or not what the papers call bull manipulation is going on, or at the same time, certain news items fail to have the effect they would have if the street was bearish. It is all the same of sentiment at the time. In this case, the street did not appraise the extent of the catastrophe because it didn't wish to. Before the day was over, prices came back. So the point he's making there is he had a hunch. He shorted an S-ton of UP, which is a railroad. The next day, there is an earthquake, and then the market blows it off. Now, he did tap into intuition a little bit on this, and intuition is a powerful thing when it comes to trading. Unfortunately, wishing intuition doesn't make it so. There are days where I'm in a state of flow, and it's almost like I'm making trades and don't even realize the trades that I'm making, and all of a sudden I'm hearing zings go off, meaning that I'm hitting these alerts, and zings go off telling me that I just hit profit targets quickly on some of these things. I've tried to force it before. It just doesn't happen that way. So you're going to need a lot of experience, and then you're going to have to let the market come to you. And most importantly, learn to see what is. What is. And then work to get into a state of flow. And this is going to be a whole presentation in and of itself, and I've done quite a bit before on that. So I'll follow up on that in upcoming presentations, and I definitely think it's something that you want to tap into. Well, that's my time for this week. Just kind of scratching the surface again, even though we're 4 presentations into the Livermore. I'll have a lot to say more about the earthquake and how things shook out and how much money he made on the trade. And what's more interesting, or as interesting, I should say, is that he did go long the railroad when it started going back up again. And unfortunately, he listened to others and he got shaken out of his position. I'll walk you through that next week, along with a lot more that I'm anxious to cover on all this. Anyway, that's it for this week. If you need to reach me, davelandry.com/contact. Here's a link if you would like the slides from this presentation, all the other presentations combined, and a bunch of stuff to keep you busy for a long time. So I want to thank everybody for watching again, and may the trend be with you.